Welcome to Inside India. I'm Amit Singh, and these are your headlines at this hour. As markets across Asia recover from yesterday's sell-off, Indian markets are also tipped for a positive start. After sliding, remember, to a 6-month low just yesterday, the rupee also in focus as it hovers around record lows. And oil prices extending gains, Brent climbing past $83 a barrel now, even as the US says crude markets are well supplied and oil tankers from the Middle East will be guaranteed safe passage during the war. And China setting its growth target to its lowest on record as Beijing looks to shift growth drivers and build up its high-tech sectors. We'll be live in Beijing with the latest. All right, let's get started with a check on the Asian markets. It's a sea of green following a green day in Wall Street too. But talk about a comeback. You have to talk about South Korea. South Korea's Kospi has produced its best day on record, jumping over 12% on Thursday. At this point in time, of course, it's up about 10.5%, 10.27 to be precise, after plunging 12% on Wednesday, which was its worst single-day decline. The net effect, well, more or lless back where we started. It's a little to do with fundamentals, but more to do with a reversal in leverage selling. That's what investors and analysts are suggesting. These investors really borrowed money to bet on prices falling. They're now buying back those shares. And we're also keeping eyes on China as the 2 sessions kicked off, and the largest economy in Asia has set its GDP growth target for 2026 at about 4.5% to 5%, the lowest target on record going back to early 1990s. The Shanghai Stock Exchange, we're watching that. It's up about 0.74% at this point. The Hang Seng is also up about, well, close to 2% now. It was up about 1.6. Now, Taiwan's benchmark index, TAIEX, also jumping, and that's interesting to note that it's about 2.87%. Japan's Nikkei rising even more than it did in the initial part of the session at 2.5. Now it's 2.71 after sliding 3% in the previous session. So more or less a reversal of the falls that we saw. Now the Indian markets, they come online in about 45 minutes or so, 48 minutes. GIFT Nifty futures at this point in time indicating that it's going to be a bit of a climb back. Remember, India followed Asian markets and Wall Street in correction yesterday. But analysts suggested it was an oversold short-term outlook to that 6-month low, and futures suggesting that today that the market would climb back up about at least 200 points or so, falling about 380 points yesterday. Now, the volatility index is interesting to note. It's reflecting how India is clearly vulnerable to the conflict in Iran, perhaps more than most of its Asian peers. It's gone up to 23%. Gone up 23% to 21.14, and usually hovering around 16, reflecting that increased market fear. Now, India's rupee is also facing the brunt of the shock. At this point in time, it's at 92.1330. But let me just dive a little deeper into that, because when it has acted like the shock absorber in the past, remember when India was facing that 50% tariff from the US, but now it seems worse. The rupee fell to as low as 92.30 against the greenback before closing at 92.15. But the 0.7% fall or so was its worst single-day slide in over a month. Now, that makes it the worst performer among other Asian peers. And of course, the circumstances are clearly extraordinary, with several companies playing the force majeure card. But when does this become a concern, a real concern? So far, the answer is it depends on how long the Iran conflict goes on. And Pete Hegseth just said the US is just getting started. Is it probable then that the rupee will hit 93, 94 even, as crude prices continue to climb? Let's not forget that the Dixie continues to strengthen, adding to pressure on the rupee. And the central bank's cutting cycle was, remember, at its close almost. But does this reignite thoughts around that when transmission of those cuts is clearly facing the roadblock of Iran, of higher oil prices? And yet, Indian stocks aren't facing the kind of rout we saw in South Korea yesterday, although that's, as we said earlier, been dramatically reversed today. In fact, this is a slight relief for one particular sector, IT services. In India, they were the only sectoral index that was up yesterday, even if it was only about 0.11%, since exporters, remember, reaped the benefit of a weaker rupee. And that's part of the reason why former chief economic advisor to India, Arvind Subramanian, is not that concerned when he spoke to my colleague Lisa in Bangkok.
In India, inflation has generally been low, so the exchange rate depreciation is not going to have a major inflationary impact. But on the other hand, it's also good for India's exporters. So I'm not as worried about the currency decline in India. I mean, it's a matter of pride, strong currency is good, but I don't think economically it's such a bad thing, because it's part of the shock absorber mechanism when you have an external shock.
And let's just bring in China at this point in time, because China's annual National People's Congress is underway. A huge event with Beijing laying out its economic roadmap for the year ahead. And our China reporter, Elaine Yu, has been tracking the developments live in Beijing, right there in that cold, braving that cold, and just giving us the latest on what's happening as the developments keep coming in. Take us through what are some of the key lines that we have seen from Premier Li Qiang, his speech this morning. Go ahead.
For sure, Amito. So the main headline here, China has set its growth target for 2026 at a range of 4.5 to 5%, saying that it's striving to do better in practice. But this is the first cut in 3 years and the lowest growth target in decades. And analysts say that this formalizes China's pivot from quantity to quality in terms of growth and lowers the pressure for a broader-based stimulus, and also gives China more flexibility and room to do things like fight excess competition and with all the geopolitical uncertainties. Beijing also announced a targeted fiscal deficit ratio of about 4% of its GDP, same as last year, and CPI inflation targeted at about 2%, and that is also in line with last year. Now, in terms of the 5-year plan that China has also announced, the key words here are high quality growth and new productive quality forces. This is a phrase that China has used in recent months for things like AI, semiconductors, and advanced manufacturing. And industrial upgrades is also a key focus here. Let's take a listen to what the premier said about a high-quality development in key manufacturing chains. Take a listen.
We will foster some emerging pillars, and we will also nurture industries of the future, such as future energy, quantum technology, embodied AI, brain computer interfaces, and 6G technology, among other future-oriented industries. We will roll out mechanisms to help grow SMEs that use specialized and sophisticated technologies so that they will become the leaders of future technology.
And I want to elaborate a bit more on China's fiscal stance, as a lot of investors are watching that in terms of how much Beijing will power that growth and the money it's spending. So a total of 1.3 trillion yuan of ultra-long special treasury bonds will be used to continue supporting major national strategies, enhancing security in key areas, and carrying out large-scale industrial upgrades and consumer goods and trade-in programs, and also 4.4 trillion yuan of local government special bonds for things like replacing hidden debt and settling overdue payments owed by the government. Amitosh?
Elaine, I'm very keen to understand more about what was just said, that China believes it's now the world leader in R&D for AI and how Silicon Valley will react to that. And of course, I'm going to ask you to stay right there and join me in this next conversation as we speak to Trinh Nguyen. She's a senior economist at Natixis and has been quite a serious player in our conversations on the economy for quite some time now. It's good to see you, Trinh. I just want to first start by understanding a couple of different things when you just zoom out on what's really going on in China, Iran, and India. Your first response to the top-line details emerging not just from Elaine's reporting, but what we've seen and heard from the Premier. There are no surprises that China has set the lowest ever GDP target. You didn't expect any fireworks, but did you see any sparks in the tone, the language of the Chinese Premier that acts as signals with Trump's pending visit to China and the war in Iran?
Well, I think the focus is really defense and debt for China. We were expecting 4.5 to 5%. We didn't expect any big bang stimulus. China is really happy with just a slowing growth, but gradual growth. And the focus here is on security. Security in terms of defense is still rising by 7%, given that other sectors are not growing as much. It's really growing a bigger share. The second thing is really this innovation push is really about self-sufficiency, chips, AI. And if you look at what's happening with the war in Iran, it's really not just hardware, but also software behind the fighting. And I think China is looking at it very seriously. So when investors investors look at this, they're seeing that it's moving forward. A bit of a disappointment in that consumption is really not highlighted as much, that is focusing much more on defense and debt, which is allowing for sectors such as real estate or consumers to really manage it rather than boosting them, which is what some would hope for, but we weren't really expecting that.
Yeah, and just to follow up on that, the consumption language, as you say, it's been the same to what the government has been saying. So no surprises there and no stronger language or refreshed language that some were hoping for. So how would you describe China's positioning then in the coming year or coming few years? You mentioned the focus is on security and innovation. Does that mean that China will still rely quite heavily on exports then, given that there is all that focus on industrial upgrades and advanced manufacturing and in tech and innovation as well?
Absolutely, right? So if you look at the data, it's actually quite underwhelming for domestic demand. Retail sales have been quite weak. Fixed asset investment is even more worrying. So when you look at China's bright spots, it's really the tech sector. It's really the exporting engine. And exports continue to be strong. Of course, it's facing headwinds in terms of backlash against overcapacity, including onshore. Now we have another challenge for China, which is while the tariff shock is fading, we're facing an oil shock. And it's just not an oil shock, it's a gas shock. It is also a coal shock, right? Energy prices are going up and China is very energy dependent. It's still very fossil fuel dependent, even though it has a lot of reserves, even though it has a much more diversified energy supply than other countries, in particular even India. It is still heavily dependent on importing of it. So the longer this crisis lingers, it means it's erosion of profit margins. It means that import costs are going up and someone has absorbed that. And I do think that in this environment, it's looking at very cautiously. So rather than stimulating consumption and so on and so forth, it's looking how to really putting a backstop to it, given the external backdrop. So again, defense, security, and within that defense is really defending external shocks as well.
And what does the MPC session and the work report tell us about China's economic rebalancing in the medium term? Because it does talk about aiming to have a quote, notable increase for consumption as a share of GDP. But as you say, it's not really looking to change consumption in terms of what we're seeing and how they describe it. They have those bonds or for consumer trade-in programs and things like that, things that they've done before, perhaps a bit of a short-term boost with those trade-in subsidies. But what do you think all this means for any economic rebalancing?
One of the positive news that we got earlier this year before the war was really the appreciation of the renminbi, right? Many had called for the appreciation of the renminbi to really have purchasing power rising so that it can import more. So it's really tilting away from relying so much on supply side and more demand side. But really the people who step in, it wasn't really happy with just such an excessive appreciation of the renminbi. So I do think that they are trying to rebalance. They are trying to have much consumption becoming a much stronger part of the economy, but at the same time, how to go about it and prioritizing what is most important at the moment is also quite important, right? And I do think the tone here is that defense, stability, and security is much more important. While consumption is soft, it's really not falling off the cliff. And so we still had quite decent growth in 2025. We're looking at softer growth in 2026. So therefore, I would say that given that it's not a big focus, it's not going to have the priority of policy decision. It doesn't mean that it's not important. It is just not what is being emphasized. And therefore, we should be quite sanguine about China being a driver of regional growth and global growth. And rather, it would probably continue to be an exporter of goods to the world, which creates tensions.
And moving on to, you mentioned earlier the war and oil as well, and the world report talked about energy and food security too, but I want to highlight energy security here. So the market has really absorbed more of the Iran conflict now. And in terms of its impact on China, now that this volatility, this geopolitical shock, it's really hard to say where it will go. And of course, China has been increasing its oil stockpiles in the last year from places like Brazil and Indonesia. But how do you think the Iran and U.S. conflict, the geopolitical situation in the Middle East, will impact China in the coming months?
The question is really duration, right? In the short term, if you look at the way assets have moved, China is one of the more shielded for many reasons. One, of course, is much diversified supply, still very dependent on import, but the fact that it has reserves are much more diversified. The effect is negative, but not so negative as much as other countries. But the reality is the longer this lasts, that is still a huge negative. And the fact is that Asian countries are quite impacted via natural gas, via oil. We're quite dependent on Qatar, for example, for natural gas. We're quite dependent on the Middle East. So longer term, even if we were able to secure alternatives for sources, if prices were to go up, and they have gone up, so this is not an alternative scenario, this is a reality. The question is how much longer will it stay up and how much higher it will stay up, and that depends on the duration of the war. If that were to be, it is a negative shock. It's a negative growth shock across Asia, and including China. China is a net importer of energy, and that will be a negative growth shock. So that is something to be mindful of. And so the war itself is being widely watched. Today we cheer in terms of financial markets, and that we expect somehow overnight, given the tone of the market, that this will be short-lived. But if it were to be prolonged, that negative growth shock would be felt across the region.
The volatility is quite evident, perhaps most in South Korea, as we've just seen. I want to just talk a little bit about defense and security. China kept defense spending growth at 7%, the slowest since 2021. But more importantly, it reiterated national reunification and the need to strengthen strategic resource reserves, including rare earths. Now, how should the rest of the world read this amid rising geopolitical tensions that you were just talking about? It's clear that the priority for China is the tech war rather than the military preparations for traditional war. Does it set China now on the path to have an advantage on the U.S.?
I think defense is a big deal for every country. If you look at the budget in Japan, it's higher. If you look across the region, defense it's obviously on the top of the mind for many reasons, not just the war in Iran, but look at the U.S. pushing for allies to spend more in defense. And geopolitics is really the topic of the year and probably the topic of the decade as we look at how the U.S. is going to play in terms of being a big player in the region. So I do think that it's not just China, and the fact that China kept it at 7% means that it remains quite a large budget. If you look at the size of China's defense budget relative to the rest of Asia, it's massive by comparison. For regional players looking at it, will continue to emphasize defense as a key. And defense isn't just on building missiles, submarines. So we have to talk about cyber and so on and so forth in other areas. And I think for China, when it talks about defense, it doesn't talk about arms, but also in technology, in the ability for self-sufficiency. How long can you last, right? When we talk about Iran and the U.S., is really, if Trump decides what he calls a win and walks away. But at the same time, it is also the duration of how long they can fight at the attrition. So to do that, you have to have supply chain and resiliency. And this is something that everyone is looking at for now. So the supply chain that we're looking at directly right now is the energy supply chain, but it is not the only one that is important in a scenario where global trade breaks down and we have conflicts widening to regional conflicts.
Okay, it's hard to make that assessment of how this compares to the U.S. But let me just ask you, given your primary focus has been on just understanding how central banks react to situations like this, how will the central banks in India and China really respond to this incipient oil price shock? Is an interest rate hike now on the cards, or will they be tempted to look through the spike as a one-off?
First, the good news is that we have very low inflation in Asia. That's a very good news. So we're starting at a very low base in which we can absorb this, right? So we're very happy to say, well, let's let the FX absorb the shock. whether it's the yuan depreciation or the INR versus the dollar. So the FX buffer, first line of defense is there, and that is actually quite helpful. Now, energy shocks, again, it really depends. It depends on duration. It depends on spillover. Is it going to spill over to fertilizer, which then spill over to food supply chains? Is it going to lift cargo beyond tankers into dry bulk? Right now, dry bulk is not so effective. Dry bulk means goods being shipped across the world. Once you have that increasing, then the inflationary pressure can be quite large. Now, we then have to talk about how would we deal with this in Asia? Traditionally, when you have an energy shock like this, countries in Asia, particularly governments, tend to try to help household sectors by extending subsidies. And those subsidies in India in the form of fertilizers, which they have, or in South Korea, quite substantial to mitigate the cost. But irrespective, this is a bigger cost, and therefore central banks across the region are not going to do any cuts for now. We actually took out the cut we have for India that was scheduled. We expect it to be in April, but we don't think that's going to happen. In fact, central banks are probably increasingly have to talk about upside risk to inflation should this crisis goes on longer and be quite vigilant in doing so. So I do think that limits the room to maneuver, especially if growth becomes softer. The good news is that if you look at the PMIs across the region, except for China official PMI, they were quite supportive. They're quite positive. Before this, we had a positive shock from Trump tariffs going from 50% to 10% for India, and Southeast Asia from 20s to the 10%, right? For China, even the tariff shock is getting lower. So we're fading the tariff, which means hopefully higher exports. But now we have imports getting higher in terms of cost. And moreover, for many Southeast Asian countries, and including South Asian countries such as India, we have a big question mark of income from remittances, whether or not they can be sustained if the conflicts widen. So I do think that a stagflationary environment is a risk. It's not a risk just yet, given the fact that we're still assessing how long this is going to go on. We're still on day 5, day 6. So it's still very early, but therefore, central banks are still going to be quite mindful of the volatility of the market to try to smooth out excessive volatility, whether it's equities or FX. But at the same time, they also probably not going to use the interest rate angle yet, which is to hike, given the fact that we have a downward growth shock and upside inflation at the same time hitting potentially. So for now, they'll probably stand pat.
Okay, we'll have to wait and see whether the RBI can prevent the rupee, for example, from hitting 93 or even 94. But final question, China has built a far larger strategic reserve and really diversified its energy sources. And that focus was really reinforced again today. And India is surely moving towards renewables, but has less emphasis on strategic reserves at this point and has, in fact, pivoted back towards energy security given the circumstances. So how vulnerable, if you had to quantify, is India compared to China?
India is more vulnerable. It's not that much more vulnerable. Say if you were to compare it to Pakistan, which is totally reliant on Qatari LNG. So I do think that India has improved for itself. I think comparing with China means that, but it's still very comparable. Still roughly 60% coal dependency. It's just that China has a much higher share of non-fossil fuel than India, but it is also expanding. So it's moving in the right direction, in my opinion, but still massively dependent on fossil fuel for its growth.
All right. Well, thanks so much for that. Trin Nguyen from Natixis. And Elaine, continue that amazing coverage. We're going to come back to you, I'm sure, through the hours. Coming up, conflict in the Middle East keeping the world on edge. We'll be back with the latest. Welcome back. You're watching Inside India. The U.S. Senate has blocked a bid to limit U.S. President Donald Trump's war powers. The bipartisan resolution aims to put a stop to the war and require that any attacks on Iran be authorized by Congress first. Mixed sentiment in the Senate, with the votes split 53 to 47. But the conflict continues to escalate. An American submarine sank an Iranian warship off Sri Lanka's southern coast, the first such strike by a U.S. submarine since World War II. U.S. Central Command said the vessel was targeted in international waters, describing it as a decisive blow to Iran's naval capability. Sri Lankan authorities reported at least 80 people killed and several sailors still missing. After the strike, the ship was returning after taking part in the International Fleet Review 2026 in India. U.S. Defense Secretary Pete Hegseth called it a clear message to Tehran as tensions continue to rise. The question is, will the oil markets take it as a message to the rest of the region? A quick check on oil. Therefore, Brent crude is still going out there at 83.81, just about 3% up. U.S. Treasury Secretary Besant, he did speak to our U.S. colleagues and assured Americans that the rising prices in oil would not translate to higher prices and that more help was on the way. The question is whether, well, people will buy it. All right, we will now head to the IMF's Asia in 2050 conference in Bangkok and speak to the Secretary of India's Ministry of Electronics and Information Technology, S. Krishnan, the man who's overseeing India's AI push. Stay with us. We'll be right back. All right, welcome back. 15 minutes for the market open in India. At this point in time, this is how we're shaping up. We're looking at a slight upside. It's going to be 24,650 or so, given everything that's happened in terms of not just the Wall Street, but the rest of the Asian markets. Indian markets probably going to track that. Remember, it did fall quite a bit yesterday, 24,480, Nifty 50s close. We're watching the rupee. Remember, it's been yet another low for the rupee, and what we're hearing based on Reuters reporting from comments coming in from traders that the Indian central bank did likely sell US dollars heavily before the local spot market opens. So there is clear intervention coming in, and therefore you see now the rupee going from that 92 mark to about 91.5 as we were speaking, and that's quite interesting. Remember, we're going to watch this space very closely. What is the psychological mark and where the central bank comes in to stop volatility and speculation as it terms it. Now let's head to Bangkok. Our East Asia reporter Lisa Kim is at the IMF's Asia in 2050 conference and standing by with a very special guest, particularly when you think AI in India. Lisa, take it away.
Hey, Amatoj, that's right. So I am at the sidelines of an IMF event, and there's lots to talk about. And when it comes to India, there's lots to talk about regarding AI and so on and so forth. So I have with me S. Krishnan. He's the Secretary of India's Ministry of Electronics and IT. Thank you so much for making the time to come on the show.
Thank you. Thank you for having me.
I want to start off with the developments that we're getting out of the Middle East. According to recent data, the UAE was the second largest market for India's electronics exports after the U.S. How do you expect the Iran war to change that dynamic, if at all?
I would believe that this would be a short-term impact, and UAE is from their ports is where it goes into other markets, both in West Asia and in Africa. And of course, it's a disruption, but we would hope that this is a short-lived disruption and we would be able to resume normal trade through those channels fairly quickly.
And India has been scaling up electronics manufacturing with regards to smartphones, semiconductors, components, positioning itself as an alternative manufacturing hub to China. But due to the conflict, shipping through the Strait of Hormuz has become challenging. So how exposed is India's electronics sector based on the analysis that you've been doing?
The electronics sector itself, if you look at the kind of exports that take place in the electronics sector and also imports, a lot of it is air cargo. It is not necessarily by ship, except the large equipment which needs to come in, which sometimes comes in sea cargo in containers. Most of the rest of it actually just flies in. And that is how that supply chain works.
Okay.
So to that extent, I would expect that the disruption will not be as major as to certain other bulk cargo items or larger cargo items, including textiles, etc. So the impact on the electronic sector is not going to be as major as some other sectors. But again, we will have to adapt to what happens in that area. And as I said, we expect that it's not going to last very long, and therefore we should see fairly rapid recovery.
I see. And are companies flagging risks, sharing concerns with you? What sorts of conversations are you having with companies, Indian companies?
I think what it underlines more than anything else in terms of the global risk is the resilience of supply chains. This is what we've been working towards, and in a sense, this particular episode also underlines the importance of having alternate supply chains and making sure that you have alternate sources of supply to insulate against various kinds of risks, including geopolitical risks.
Could you tell me a little bit more about your efforts to diversify supply chains?
Key elements include semiconductors, as you pointed out. In the semiconductor supply chain, the most recent development, of course, has been Micron opened its first plant for commercial production in India, and we would see more expansion during the current calendar year. In 2026, at least 3 more such plants should come on stream. I think that will be an important contribution, not only to demand in India for certain kinds of semiconductors, but also to support what happens globally. Likewise, in terms of electronics, in a number of components, the electronic component manufacturing scheme has been a success. A number of plants are getting grounded as we speak, and we should see India also emerge as an important location where manufacture of electronic components takes place, which can go into the assembly supply chains as well. It will support not only what is happening in India in terms of mobile phones and other devices, but also supply what happens elsewhere. One of the lesser known facts is about almost more than $1 billion worth of exports of components took place from India during 2025, which is new, which normally doesn't happen to that extent. So that we expect to grow significantly.
I see. Does the Indian government have plans to offer more incentives to global companies to move more of their business or operations to India?
As you're aware, again, in the budget for 26-27, presented on 1st of February, the finance minister announced that the India Semiconductor Mission 2.0 would be launched, and that is expected to come up in the coming months. And likewise, the overall allocation for the electronic component manufacturing scheme was doubled. It was increased to 40,000 crores in Indian money. And likewise, we are working on a production-linked incentive scheme for mobile phone manufacture. The present scheme will come to an end on 31st of March, and therefore we will have to have something which follows it up.
And I would like to get your thoughts about AI and India. When it comes to AI, Europe has chosen a path of regulation, whereas US has let markets decide. Tell us about India's approach to AI.
I think India's approach to AI is to allow innovation to bloom, and innovation goes first. Our approach to regulation has been very limited. We are relying on existing instruments of policy and existing laws and not going beyond that. And for the present, that is what we are relying on. We believe that there has to be more innovation, and AI has to support productivity gains in various real sectors of the economy, and that should be given full play. At the same time, there are some aspects which cause trouble or which could cause certain harms in certain segments. And those alone we are addressing, particularly misinformation and disinformation. So there's a requirement that content which is put up in social media needs to be flagged if it is artificially generated. Synthetically generated information needs to be labeled as being synthetically generated.
Yeah, the government's rule mandating faster content removal on social media platforms. Are there any plans to talk more with the industry so that it could ease friction? Because I know that's receiving a bit of pushback from some folks.
We are in regular touch with the industry. We speak to them regularly. India is a very big market for the social media intermediaries, so they are well aware of the sensitivities of the Indian market and where harms could come from, and they have been extremely cooperative. So we really don't have such a serious issue. They do have some technology-linked issues which they are resolving.
So last month, concerns over AI wiped out tens of billions of US dollars worth of Indian IT stocks. And given how IT is a huge export sector for your country, how concerned are you about this trend? Just really quickly.
The real issue there is that the nature of the business in the IT and ITES space is bound to change. That is something that our companies realize. We have been in discussions with them. We believe that AI gives them a new opportunity to develop applications which they can then deploy, and that is where most of the human resources would get absorbed. The traditional lines of business will see some shrinkage, but there could be considerable opportunities for expansion in the newer lines of business.
Thank you so much, Secretary.
Thank you.
That was Secretary S. Krishnan for India's Ministry of Electronics and IT. Back to you, Amitabh.
Lisa, thanks so much for that very riveting conversation. The latest insight after India also hosted the Impact Summit in New Delhi, where so many leaders across the world had come, and Mr. Krishnan was actually overseeing everything there. Really appreciate that. Meantime, the shock of higher oil prices and the conflict in the Middle East is being felt through the travel industry across the world. And CNBC's travel and transport reporter, Monica Petrelli, has been really keeping tabs on what's going on. These are the details in her report.
Airfares between Asia and Europe are soaring as major transit hubs in the Middle East remain closed. Now, while airports in Abu Dhabi and Dubai are working to evacuate travelers stuck in the UAE, hundreds of thousands of other passengers were scheduled to connect through these airports this week on flights that have since been canceled or rerouted, often on longer and thus costlier flights. Now, as airports and passengers scramble to adjust, some routes are now fully booked through mid-March. For example, the cheapest route from Singapore to London, departing next Monday, that avoids stopping in the UAE or Qatar, is nearly $1,200. It's 30 hours long and requires flying on 3 different airlines, with a connection in Riyadh. A joint JAL and British Airways flight is just as long, yet more than twice the price. The first available flight on Singapore Airlines isn't until March 17th, priced at $3,350 for an economy seat. Now, airfare on flights from Hong Kong to Paris weren't much better. Flights on Cathay Pacific are full through Monday, while its first nonstop is more than a week away and cost $7,300 US. Now, road trips may be going up too as petrol prices are rising around the world in places like Australia, Philippines, and Singapore to various parts of Europe. France's finance ministry is set to meet with petrol distributors today to discuss price protections. This as national gas averages in the U.S. topped $3 per gallon this week, and diesel rates rose above $4 per gallon for the first time in nearly 2 years, both which pose problems for the Trump administration as Americans struggle with cost of living increases. I'm Monica Petrelli for CNBC Business News in Singapore.
All right. Well, there you have it. Travel patterns completely disrupted. Take a look at oil again, where oil prices are right now, continuing to rise. The Brent at 83.80, and of course, light crude at 77.22, inching closer towards 80. We'll be watching this space very closely as we take a deeper dive into the oil flows right after this break. As we count down also to the market open in Mumbai, expect a lot of movement as we have seen in other Asian markets. Welcome back. It's just about a couple of seconds before the Indian markets have come online, but let me just give you a sense of what's happened in pre-open trade. We're getting a Reuters report saying that the Reserve Bank of India did actually likely step into the foreign exchange market aggressively. 3 traders have told Reuters that the RBI tried to shore up the rupee, which, remember, fell to a record low in the previous session. Take a look at the market open now. The rupee was at 92. Now it is strengthening against the dollar at 91.5. And of course, Iran, the conflict, oil prices, and the strengthening US dollar and put the potential of the changes in the Fed, all of that playing a role here. But the Nifty 50, as expected, based on futures, rising about 0.3%, and expect that to climb a little bit more, given that Asian peers and Wall Street also had a rise. And as I speak, it's already happening, closer now to 0.5%. We'll watch this place very closely, but let's look at oil refining and marketing companies right now, because that's where the focus is, given the conflict in Iran and, of course, the Strait of Hormuz effectively closed. You're looking at very interesting situations developing there. Indian oil up about 0.4%, Oil India about 0.1%, and the private player Reliance up about 1.3%. Oil and natural, that's ONGC, we'll be speaking about that in a bit, also up. But the focus right now, the concern rather, is on what's happening with gas and LPG and LNG. And therefore, when you see GAIL India up nearly 1%, that augurs well for the sentiment right now that we are seeing. Several Indian energy firms, remember, did invoke a force majeure, in other words, an uncontrollable event that prevents a contract from being carried out. And they have cut their domestic natural gas supplies as the Middle East conflict disrupts LNG shipments, particularly from Qatar, like in the rest of the world. Now, India's key supplier is Qatar, so perhaps disproportionately India is going to pay more attention to what's happening there. Petronet LNG Limited has issued a force majeure notice after its LNG tankers were unable to reach Ras Laffan, Qatar's main export terminal. State-run buyers, including GAIL and Indian Oil Corp, have already reduced these gas supplies to industries, and this is based on reporting that's coming. So we're watching how the reconfiguration of India's energy mix is taking place live, really. Gujarat Gas Limited said it will restrict supplies to industrial customers starting Thursday. So far, there are no announced cuts for household or CNG users, but we'll be watching the space for that particular development. And to talk more about this, about the future, the immediate near-term future, we have Prateek Pandey. He's the head of APAC Oil and Gas Research at Rystad Energy, based in Singapore, right here with us, but of course from India. It's great to have you with us. Prateek, I want to just start by understanding the situation of gas, because analysts have been speaking about the concern being a little more for this space, LNG and LPG. How dire is the reality for these supplies for India?
Well, overall, I can say that India is one of the most exposed major economies in the world due to the closure at the Straits of Hormuz. And whether it's in terms of crude oil or LPG or LNG, specifically on the point on LNG and LPG, the runway is much shorter than crude oil, which is why there is more immediate concern. And in fact, on gas, we already see the supplies being reduced to the industrial buyers in India. And there are not many alternate options available to India, unlike oil, where we do see there are some options to buy additional crude from other countries, but that's not the case immediately in terms of LNG and LPG as well.
Okay, give us numbers. How many days of reserves does India have in LNG and LPG?
So India depends almost 55% of its LNG imports on UAE and Qatar, Qatar being one of the big suppliers there. As of now, we have about 2 weeks of runway for LNG, which could possibly increase if we are reducing the supply to the industrial buyers, so that we don't have any immediate implications to the power sector. But that also wouldn't be very long, not more than 3 weeks timeline.
Okay,
yeah,
interesting. There's this aspect that I want to just understand from you, because when you have this conversation around the reality of these supplies in India, we're also hearing that, and you were mentioning this, I've put it out there, based on reports that we are getting, that reconfiguration is taking place, that they are cutting the supply to certain areas and saving it for future needs. Are you hearing this yourself also, or you're just basing the comments on what these reports are suggesting from the likes of Reuters?
We are hearing this from the market, definitely, okay. And we do see that as one of the immediate alternatives that India has.
Okay, that's good to know. I want to just bring in right now, because we're talking about LNG, we're talking about gas. Arvind Subramanian, the former Chief Economic Advisor of India, was on our air just a couple of hours ago, and he said the impact of natural gas supply reductions will be much more than oil, clearly in line with what you're saying. Let's just listen to that.
at the moment, it's looking pretty uncertain, and already you see it in prices. I think the interesting thing is, take a country like India, for example, right? It's going to be affected a lot more by the natural gas supply reductions than the oil.
There you go. Okay. How many days of oil now? Switching the conversation. Oil reserves does India have?
So India has currently access to about 100 million barrels, which in a way means about 40 to 45 days of the runway on the crude oil. In a way that means we won't see refineries being impacted in the timeline of next 3 to 4 weeks. But post that, there will be concerns. When we talk about that, we need to keep in mind any alternates also are coming up, but they will take long time for the shipments to reach India. For example, if we talk about US or Venezuela as the alternate, it takes almost a month for these cargoes to land in India.
100 million barrels is what you're saying, and that's an interesting number because what India needs is 5 million, and the supply that's now not there is 2.5 million that was coming from the Middle East, as we understand. I just want to dive a little deeper into what you said, Venezuela and the US. Hey, there's Russian oil sitting right next to India. What about that?
Absolutely. So in the immediate action, I think any Russian supply which is in the Arabian Sea already but doesn't have firm buyers, India will target to get those to the Indian markets. But that wouldn't be a big volume. That would be about 5 to 10 million barrels in total. In the market post that, India will buy additional possibly from Russia. It's also keeping in mind the objective of economics over geopolitics that India has followed for last few years almost, and they will likely continue with that in the current market as well.
Okay, I want to get into the economics, but I just want to dive a little deeper into the geopolitics of buying from Russia. Trump saying that India has agreed to not buy any Russian oil before the Iran conflict broke, something India did not confirm, and that's not a concern for you. You're saying that India's economics will drive its oil strategy.
That seems to be the case. Also, if you see how India has scaled down Russian volumes, it was about 1.8 million barrels per day of Russian imports towards the end of Q3 last year. It is still one of the top destinations for India to import at about 1 million barrels per day.
Just to put it in perspective for our audience, it was 35 to 40% earlier. Now it's about 19 to 20%.
That's exactly the case. The market which has increased in the meanwhile is Saudi. That has grown from about 600,000 barrels per day to over 1 million barrels per day. But that market is being challenged now. So it's not like India has replaced Russian volumes with US crude oil.
Or Venezuelan.
Or Venezuelan. So now, given that India doesn't have access to Saudi volumes, there is likelihood that India will move back to possibly thinking of additional Russian volumes. Of course, there will be thinking on getting additional Venezuelan or South American volumes. But even if you look at the size of supply that Venezuela and South America can add, there is a higher number that India sees from Russia.
Where do you see oil prices go from here, or given the signals you're getting from the US?
Well, it highly depends on how long the Straits closure lasts. If we see it lasting about 2 weeks, then we definitely have $100 on the table.
Okay, what if it lasts 4 weeks? Because that's another example of... I say this because when you have the war secretary, the defense secretary, Pete Hegseth effectively say, hey, the war's just started, we're just getting started.
Absolutely. So if it is anything beyond 2 to 3 weeks, then we are looking at the oil prices escalating above $100 as well, especially keeping in mind there have been some damages to the oil infrastructure as well in some of the Middle Eastern countries. And what we need to also keep in mind is even after the current blockade is opened, it will take about 2 to 3 weeks minimum for the cargoes rescheduling and everything to get back in place.
Okay, so clearly the clock is ticking, particularly perhaps more for India than other Asian economies because their reserves are much greater than India's, as you and I just discussed. India reportedly has the lowest reserves of several of its major peers. If you are a big oil company in the region, in India, what's your strategy, your aggression level in terms of bidding for oil from parts of the world where you can get it right now?
I think for the next 1 week, still the market expectation is that this won't last for very long because there will be severe geopolitical implications.
I don't understand that. How is the market even saying that it's going to be a short-term impact?
Because there are commitments from US and Europe both that they will escort the cargoes out of Strait to continue the trade and balance the markets.
Yeah, but the war risk insurers are not suggesting that that kind of confidence is enough.
Absolutely. We have not seen the shippers reacting very positively to it so far, but it's been just 3 days. And so I think from the Indian oil companies' perspective, that is one perspective that they have in mind. The other is they are definitely looking at any potential additional barrels, starting from Russia, but also looking at US and Venezuela as the long-term options.
Quickly, because you had the US saying it did sink an Iranian warship of Sri Lanka, killing at least 87. Given this ship was participating in a military exercise hosted by India, how much does this increase the anxiety? And anxiety is a word that I have not used. It's the Indian government that's used, given the crisis.
No, it definitely impacts. And this brings back the whole discussion of what is going to happen in terms of US escorting. Is that really possible to be executed? You got a point. Yeah.
Okay. Really appreciate you coming in and speaking to us, Prateek Pandey from Rystad Energy, giving us the perspective. Now, that's all the time we have today on Inside India. Keep watching CNBC because our focus now shifts to where the action is right now, and that's the Middle East. Axis Middle East is up next.